Hey, how's it going, everyone? My name is Amos, and I have a question for you. Do you know when to sell a stock? There's two cases, either for a profit or at a loss. In this video, we're going to talk about the strategy for the bright side of things. And no, just because my therapist tells me to let it go doesn't mean that I should sell all of my stocks. So get out of here with that nonsense. This video will be from the perspective of a long-term investor. If you are day trading or looking for a quick profit after holding a stock for a day or so, you might learn a thing or two from considering a different perspective. And by the way, I just got back from playing pickup soccer, so if my voice sounds tired, I can assure you that my nipples are absolutely exhausted. Alright, so what is a long-term investor? What are the qualities and traits? First and foremost, as a long-term investor, I don't allow emotions to guide my investment decisions. If there is a lot of greed and FOMO around Wall Street, I don't allow that to influence me. If there's a lot of fear and negativity, I don't care either. If I know a company is high quality because I did my own math and deep dive and analysis, and somehow the market prices them wrong, then I'll buy into it. As cheesy and cringy as it might sound, I actually made a slide deck of my investing thesis and philosophy so that I can always remind myself of my values and what I look for in the stock market, just in case I'm tempted to buy into a business that doesn't align with my priorities. What you see on your screen right now is a sample of that deck. And maybe if there's enough interest, I can post the slide deck up on the Patreon, which, by the way, if you join the Patreon, it would make me feel a lot better about our relationship. Yes, I am calling you out. It would finally be some commitment on your end. But jokes aside, let's look at the different strategies on when to sell a stock for a profit. Number 1, the fixed number approach. So ultimately, you sell after a gain of about 20 or 50%, or whatever number makes your butthole sweaty with excitement. And you might do this because of your risk tolerance. You might want to sell after it reaches your fixed price number that you have in your head. However, I would argue if you have an exit plan like that, then you might be short-term investing, because as a long-term investor, I buy and hold unless, reason number 2, if the company changes its mission and business model, then I would sell because it's no longer the same company, especially if their economic moat disappears or their industry becomes impacted. Those are valid reasons as well, such as investing into newspaper companies in the early 2000s probably was not the best idea out here. Another example for reason number 2 is if I were a shareholder of Nokia in the early 2000s and I saw the Apple iPhone presentation given by Steve Jobs, this is what I would do. I would tidy up my work desk, go home, sit in my toilet, drop in number 2, log on to my investing platform and sell all of my Nokia shares and buy into Apple instead. Reason number 3, if you are in the grain with a company and you think that it's going to be headed towards the direction of cutting the dividend in the near future, it's probably safe to sell it before that happens. There's going to be signs and warnings along the way of a potential dividend cut, such as they tackle on an alarming rate of debt, they run into cash flow problems, they're not profitable anymore, and the dividend payout ratio stays above 95% for a quarter or 2 or 3 quarters in a row. If the company starts doing weird behavior like that, you can go ahead and assume that the dividend is probably not going to be safe, and so that's probably reason enough for me to sell out of a company. Because once their fundamentals change, their future is going to look drastically different. Case in point, I used to be an avid investor of Cracker Barrel, which is a restaurant chain that is all over the US based on travel routes. However, their brands and logo and their message is not resonating with the younger generation. Consequently, they're seeing less traffic go to their restaurants, and the company started running into financial issues. Once I started seeing all of that happen slowly, I sold out of it before that stock crashed as a result of declining metrics and slashing their dividend. Let's move on to reason number 4. You would sell a stock for a profit when there's better opportunities. If you need the capital for a down payment, to pay a tuition for your child, or a big purchase item like a new car, then that's a question that you have to answer yourself. Are you willing to sell out of Microsoft, Visa, or even Google in order to pay for that mortgage down payment? And it doesn't even have to be a purchase in real life. If you see a better opportunity in the stock market, such as an undervalued compounder, it's not the worst idea to sell profits from this company that you're invested into to have that capital on hand so you can buy into that undervalued company. For instance, about 3 weeks ago, this is a very fresh example, I sold out of all of my Visa stock gains and I bought into AMD instead. AMD right now, friends and family, super beaten up. And I think the market is not pricing them appropriately. So the reason why I made that pivot is I think I can get better gains in AMD than in Visa, at least for the next 5 years, that is. I made a video articulating my buy price and bull case for AMD if you're interested. I am not recommending anyone to follow me into AMD, but if you are at all curious about why I made that move, then watch that video. And the next reason, balancing profits and your tax strategy. Tax implications play a huge role in deciding when to sell a stock for a profit. If you sell that investment within a year, you're going to be hit with short-term capital gains taxes, which are taxed at your regular income rate. Ouch, no bueno. But if you wait over a year and you hold on to it for like 377 days or whatever, then you get the much friendlier long-term capital gains tax rates, which depending on who you are, could be 0%. However, sometimes things happen. So if you need to sell out of a stock after being invested into them for like 5 months or so, a smart move might be to sell a part of your portfolio in a year where your salary income is lower, like when you're a student or when you're about to retire, which can help offset living expenses and keep your tax bill in check. There's so many different ways to strategize, so planning ahead of time can really pay off, quite literally. That's just one example of how you might want to sell when your tax bracket is a little lower. Reason number 6, this one is really similar to reason number 1, but instead of a percentage, a fixed number that you have in your head, you operate with a tangible price in mind. And when it reaches your price target, then you sell out of it. Such as, let's go ahead and say that you bought into a company when it is on a massive discount at about $40 a share. You did your research, you did your homework, and you find out that, hey, this company is actually worth $100. So eventually, whether it's 6 months or in 3 years, when that company reaches your price target of $100, then you sell out of it. And why might you do this? Well, let's go ahead and look at a very recent example in Cisco. So Cisco, ticker symbol CSCO, is a do-it-all company in the IT and networking industry. Right now, they're currently trading for about $60 a share. But check this out. If you were to have bought into Cisco during the dot-com bubble crash in February of 2000 at $62 a share, you would still be in the red with Cisco. Of course, not in your total returns because the dividend is quite juicy, but still, your original investment into Cisco would have been at $62 a share, and then unfortunately, the following year, in like 2001, it would have dropped to about $18 a share. $18 freaking dollars a share. And after about 22 years, you would have just maybe have broke even with Cisco. But let's go ahead and back up a little bit. Let's say you bought Cisco instead in 1999 at the very awesome price of $33 a share. Had you have held on to Cisco through the dot-com bubble crash, you would have seen it jump up to $77 a share and then down to $62 a share and watched it crash all the way down to $14 a share. And for Cisco to hit $33 a share again, it would have taken another about 7.5 years or so for you to break even. So instead, if you were to have bought into it at $33 a share and you sold out of it right here, you would have been an awesome winner. And you would still, 25 years later, be bragging about that story. But anyways, timing the market is super hard and difficult and a challenge. All that to say, that's why it's so important to understand what the intrinsic value of a stock is. That way, you know for yourself when it's overvalued or undervalued. When it reaches your overvalued price area, such as when Cisco ballooned up in valuation, such as like over here, then you can sell knowing that you got a good deal. But if you just buy into a stock, not knowing what it's worth and just blindly holding on, then you're gonna have to strap yourself in for a very bumpy ride in the stock market. And I get it. Cisco is a very extreme example. So let's go ahead and look at another company. On the other hand, Meta, also known as Facebook, is currently trading for about $612 a share. But believe it or not, back in 2022, they went on a massive sell-off, and the market was very bearish about this company because they were posting very shaky finances around their advertising segment of the business, but also they didn't believe in Mark Zuckerberg's metaverse. So anyways, the stock price eventually reached about, what is this lowest? At $90 a share. I'm not going to joke. I actually picked up thousands of dollars of shares worth of Meta at around $91 to $92. And then once I hit about a 200% gain right before it hit $300 a share, I sold out of it. I'm going to be honest, I thought I was a genius. However, if I were to have just held on, then it would have compounded even further. So that $91, $92 cost basis would have grown to about $600. So by selling it right here, I killed the compounding effect that would have taken place in the next 2 years. So it all depends. Cisco is a very good example of selling near the top to capitalize on your gains because you know that the company is now overvalued. And then Meta is a very good example of if I would have just held on, my gains would have been much bigger. However, once they passed my intrinsic price target of about $300 a share, I felt safe. I didn't know that Meta was going to grow that much bigger, so it just goes to show that there's no right or wrong strategy. All that to say, buy and hold investors tend to perform the best. The ones who held on to Apple for 20 years, the ones who bought and held on to Walmart for 30 years, or the ones who bought into McDonald's and held on to it for the past 50 years, those investors are the true winners of the stock market. But it requires buying into a very high quality company in the first place and then letting it do its thing. Compound over time, such as Meta. So the high quality compounders are the best investment vehicles, but dead people are the best investors. Apparently, there was an internal review at Fidelity where they reviewed their customers' brokerage accounts. They found out that the best performers were the customers that were no longer alive. The ones that had solid investments, and because they were dead, they just let their portfolio holdings ride and grow and compound. In a weird way, kind of like a long-term investor. No action in holding high-quality compounders will be beneficial in the long run, which is in contrast of this. Just the other day, I posted onto the YouTube community a study that showed only 3% of day traders make a profit. The other 97% are literally losing money. Day trading involves way too much speculation and gambling, kind of like trying to guess which line at the DMV is going to move the fastest. They're all going to be slow. Just bring something to read and chill out. But if you're on the fence about a style of investing that you want to adopt, I think the long-term approach is the one that I would pick 10 out of 10 times. To buy and hold a high-quality dividend compounder, it's pretty sound advice for most people out here. Of course, when you want to sell, it depends. Ultimately, I hate to be that guy, but there is no wrong answer. Profit is still profit. You can sell when you think it's appropriate for your risk tolerance or portfolio goals, whether you make 10% gains on your original investment or even 10,000%. Green is still green. Of course, I still beat myself up that I sold out of Nvidia and Meta right before their rocket ship went to the moon, but hey, at least I still walked out with profits. And if you paid attention in this video, notice how I didn't give a reason to sell because of macro environment issues. I invest in a bull market, I invest in a recession, I invest all the time. Every month of the year, if there's a good deal, I'm going in. Reason being is that I'm a time in the market beats timing the market kind of guy to a certain degree. Yes, I do have my limit buy orders set at a specific price, with a 10 or 20 or 30% margin of safety baked in. But for the most part, I believe in the long-term effects of the stock market, especially when we're talking about high-quality companies. And when in doubt, remember, the stock market has a funny sense of humor because once you sell out of a company with a small profit, just know that that stock is going to skyrocket. And on the other hand, if you hold on to it thinking about selling, well, it's going to go down even lower and lower, and you're going to be further in the red. It's just the way it is. I don't make the rules, but sometimes that happens. And jokes aside, I hope you enjoyed hanging out with me, and I hope to talk to you next time. Stay safe. I love you. Peace.